In this section of the tutorial, I'm going to show you how to do regression analysis. This is the second part of an analysis exercise as I post online. I made some changes on the tutorial and will post it again. Before you follow this instruction, please install, or rather activate, the analysis tool pack in your version of Excel. Please do a Google search to find a way how do you activate that. You need go to File, go to Options, go to Add-ins. This is part of Add-in, and activate the tool pack. So do that first. You can pause this video and do the tools pack first. My tool pack already installed, so I'm going to skip the how to install the tool pack. Go directly to regression analysis. All right. Now, last week I showed you how to create a database, create a rate of return, and we also calculate the expected value, the average value, and the standard deviation. And what we see is a data, something look like that if you plot it in terms of rate of return. The nice thing about rate of return, it is scale-free. So you can compare bananas and apples, so to speak, because basically looking at the rate of return, not the absolute value of the price. Now let's look at this Apple data and S&P 500. The blue line represents the returns on Apple, and the red line represents the return on S&P 500, the index. They're both very volatile, but you can see the returns on Apple is much wider. We say volatile, the high standard deviation or high variance. The reason because the S&P 500 is well diversified, and Apple, there's no diversification, right? So now let's do further analysis and try to find out some relationship between these two. The theory, the capital asset pricing theory, basically says why Apple stocks up and down is due to market risk. We say the Apple rate of return is a function of market rate of return. Here we are using S&P 500 as a proxy for stock market as a whole. Now, in regression analysis, people usually use, if it's a single regression, usually the Y variable, we call it dependent variable. A dependent variable, just like Apple rate of return, will depend on some independent variables. Here, the independent variable, also called the X variable, is the rate of return on S&P 500. So Y represents the dependent. In our case, is the Apple rate of return. X represents the independent. Here is the rate of return on S&P 500. Let's find some kind of linear relationship. Meanwhile, we also there are two terminology you need to be aware of. When you do a regression analysis, you need to do what we call the test for the statistically significance. Sometimes you put some number together, accidentally they have some relationship. We do have a certain procedure they will calculate, they call the student T. A T statistic will tell you if that number is higher than 2. Just easy to remember. Actually, that number is 1.96. But for your, easy to remember. You find that T statistic, the absolute value, is higher than 2. It is statistically significant. Okay? You have to check that. Because if it is less than 2, there is no necessary relationship. It's a pure coincidence. The model failed, basically. The other one you also need to know is what we call goodness of fit of the model. What that means is basically how good the model is. What the percentage of the variation worked, or what the percentage of the variation did not work. Okay, you want that goodness fit. In our case, it's called R squared, as high as possible. But in financial data, because we have a lot of noise, the R squared usually not very high. With all that, let me see what I do. Let's look at the next slides. This slides. Now, this slide, here's the equation to basically describe. We have 59 observations using our Apple data, Apple S&P data. So each data on the left-hand side, each pair of data on the left-hand side, that is a return for security I. In our case, is Apple. On the right-hand side, the RM is the rate of return on the market. Well, here there is one item missing. It's RM, is the market rate of return. The last one is the epsilon. Epsilon is the error term, is a random noise, sometimes up, sometimes down. The alpha is the intercept term. And the beta here is the slope for the Apple stock here. The letter T here represents time or the date, since we have 59 observations. So it's a sequential, the chronicle order, so data. So basically we have 59 observations, and we put into computer, ask computer to run a regression. What regression function did? Here I borrowed this chart from the appendix of this textbook. It showed you the simple regression estimates. So the actual data, the value, each value we put in is something look like this with the error term. Now, the red line is the slope. Beta here is the slope. The higher the slope means high reaction of the dependent variable, here Ri, with respect to the independent variable, here the Rm. If a high slope means any change in the independent variable, the market, the dependent variable will act more aggressively. So anything more than 1 means it's more aggressive than the market. Anything less than 1 is less risky than the market. Okay? So the red line, also called characteristic line, actually is a regression line. The computer, using a maximized square error method, try to find out for our 59 observation, they minimize the epsilon part. So here is the predicted value, but the actual value is higher somewhere here. The difference between the actual value and the predict value is the error, or called the disturbance, deviation. The computer program basically is to minimize all the error to find the line best fit for it, best to fit that situation. So now I'm going to go back to my Apple data. You are going to working on Amazon, but here I'm showing the actual Apple data I'm using. So this is the first part, create the database and find all those basic parameters: max, mean, variance, standard deviation, etc. Now, remember nowadays, to my surprise, that Yahoo Finance, the download data become ascending order. In other words, if you look at the date, it will be 2012, 2013, 2014. But online, it is descending order, the other way around. But I like actually the ascending order. It's much easier, but causing certain troubles. Why? Because we're going to lose the first observation. Because when you calculate rate of return, it's P1 minus P0 divided by P0. In our case, it's a B3. Let me make this one a bit larger. Right? It's a B3 minus B2 divided by B2. Since we don't have anything in B1, so we are miss that one observation. The rate of return starting from November 2012, not October. We're losing the observation first. In my tutorial sample, it's the other way around. We're losing the last one. This one losing the first one. I like this one. Actually, it's making more sense from left to right. So when you plot, so you don't have an observation here, okay? Not the end, right? Now, so we have 59 observation, and among those data, most important will be average value or the mean value. And we find out the monthly average return for Apple is 1.5, and for S&P 500 is less than 1. Standard deviation, on the other hand, Apple is much higher, almost 7% per month, but Apple is about 3%. I'm rounded up to nearest the 2 decimal point. Okay. Now, the reason, as I mentioned earlier, this is the data show the fluctuation up and down. Notice the first 5, 6 observations, they are moving the opposite direction. That means market going up, Apple actually going down. See that? Drastically for some reason. Those are unique risk. But overall, you find the market, the volatility is much less than Apple because it's diversified away a lot of risk since we did the statistic on portfolios. The covariance, the varying covariance matrix worked to reduce the total volatility. Although you can also point it out, the average value also reduced. But the major fact, as our exercise in portfolio statistics show that, is the drastic reduction of the portfolio variance and the standard deviation. As long as these two stocks are not closely related. The covariance is not equal to 1. You have some kind of reduction, risk reduction. Now let's go to next one we need to do is we need to find a certain relationship between the Apple rate of return and Apple rate of return and also the market index rate of return. Okay. So I want to show you. Let me see. Let's put this one a little bit here. This one. Sorry, the screen is not very clear, probably in your end. So here is the procedure. So you have the data. Now remember, we have to work on the rate of return data. So in this data, we'll have the file, the dependent variable, y variable, of rate of return in column F, 59 observation. We have the rate of return of independent variable on column G. They also 59 observation. Now pairwise, you must perfect match, otherwise it won't work. Okay. So with that ready, we'll go to the tab on top of the column, the tab. Click data. In data section, there is a symbol here. Say the data analysis are already activated. Data analysis. Now you have activated in the add-in function of your Excel, and this data analysis will show up. So click the data analysis function. It come up a list of a lot of functions. We will do is in alphabetical order. So we need to use the regression. Move down to regression. Highlight regression. Then move your arrow to OK. Now, here is a key point, right? You need to put the date or the data in its appropriate position. First one is the input y range. Here, the y is the variable on left of the equation, which is rate of return on apple. So this is the dependent variable, y, apple. So we're going to, using the arrow here, click the arrow, get out of the that dialog. And the first click, in my case, is F3. Now, because we do not have one observation on F2, so we cannot starting our cell position from F1 because there's missing data. It won't work. So we're starting from F3, the first observation in rate of return. I like using Shift, then down arrow key. Slowly, do it slowly. Using down arrow, do whatever, highlight all the 59 data. Make sure that, I don't see very clear. All right. From 3 to 61, F3 to F61, yes. Click it back. Now you have the dependent variable in the observation 59 observation there. Now let's look at independent, which explain why the dependent variable change. Here is the S&P 500, the index number. It should pairwise exact the same like Apple. So click the arrow key, go to G3. Highlight G3 and move down, Shift arrow key to G61. Now you put the X variable range in your that inputs the range in it. Now you cannot check the labels. The reason, because we have a missing data in between the rate of return, the label, and the first observation. If you check that number, the Excel won't work. The function will give you some errors, give you a lot of trouble. But in my tutorial, because I did it like last year, they are in descending order. So we are missing the last observation, not the first observation. So in my tutorial, I say check the label. But here, now, please don't check anything. So in the input section, don't check anything. Okay, only put the range for X and Y. That's it. Okay. The common mistake I find out is people sometimes confuse. They put the S&P 500 in Y, put Apple rate of return in X. Now, theoretically, although mathematically it doesn't matter, it's a correlation, but theoretically it doesn't work because you cannot say market. U.S. market depend on Apple. Sometimes it's sort of. No, anyway, no, I don't think it's right. So the other way around, Apple depend on U.S. market, at least according capital asset pricing model. So in output, the option, let's use in the second by default one, you come up on a new worksheet. This is by default. The only thing you need to do here is to click the last one. It says line fit plots. I only need that one. All the rest of it, just forget it. It's the only line fit plots. It insert a straight line for you. Now let's take a look at this dialog, okay? You put input Y range and the input X range correctly. Check the new plot sheet, worksheet, whatever that is. And so also check the line fit plots. Now do the calculation, and the computer will do that for you. Let's see how quick it can do. We click OK. Voila! The computer did the heavy lifting. It did all the calculation, minimize all the error, find the line. Now, what do you do actually is interpret results. Here you have it, all the summary of outputs, and also remember we insert a line. There is a line there. There is a line there. Now, in order for me to easier to do it, I just already did earlier. So what do you do next is analyze, looking at those charts and what is the important one. The most important one is this number. It's a B18. Okay, the labels is called X variable 1. Now I think I have a I did it earlier, so I can highlight those things. So here is three things you need to do. The analysis, okay? Number one, go to B18. Go to B18. Let me enlarge this one a little bit. B18. Go to B18, whatever that number, your Amazon.com is 1.4 something, whatever that is. Now that is your beta. That is your beta. So Apple, for that, the current Apple have a beta of 1.21, approximately 1.21. Now you can change that label. It's easy for you to understand. You see, it's it's S&P 500. It's S&P 500. By the way, it's a rate of return for S&P 500. But anyway, but showed you the 1.2. You can relabel it. By default, it's just the X variable because X is the independent variable. Here, in this case, is a market rate of return. Now, you in a statistics analysis, you need to looking at what we call significance. Statistically significant. Is that number 1.2077 statistically significant as opposite statistically insignificant? My rule said the absolute value on T-stat, which reported on D18, here is 4.1635, is higher than 2. So the 1.2077 is statistically significant. You have to report it. You have to say the estimate, the beta is 1.2077, and its t-stats is 4.1635, which is higher than 2. So it is statistically significant. Oh, kind of windy, but you have to do it, right? Now the other thing is to give you a feel as how the model is good or bad. The good or bad or percentage explain or not. You're looking at the third parameter of this output. It's on B5. The title for the parameter is called R square, R to the power of 2, R square. R square is called goodness to fit, or the percentage explain. So this one explain about the 23%. In other words, there are 77% not explained. I'm not surprised. If you look at the line, fit line, I reorganized line, did some editorial on it, so put a title on it. It's the scattered, the pair of 59 observations. And I also insert, right click the line and insert some kind of line on it. Insert on line. So along that line is the predict value. That prediction, in this case, is the so-called industrial version. So y equal to, now the intercept term is 0.0033. The slope is 1.2077 times x. So this is the slope. Oh, by the way, talking about statistically significant, the intercept term 0.022, the t-stat is below 2. So it is insignificant. But we're using this version mainly is for the purpose of find the beta, to estimate the beta. So we ignore the intercept term. Okay? There's other reason that we don't have time to explain that here. So if you're looking at the chart, you see the pair actually scatter all around, all the place. Not strictly everything on the line. Not many is really literally on the line. So those are errors, those are deviations. But the regression model is trying to find the best fit line, which will give you the best fit. There are certain errors. We said the error, we call it white noise. You have same percentage overestimate, same percentage underestimate. So kind of a average value equal to 0, so to speak. So we have that. So basically your interpretation is based on that 3 parameters. First, the estimate, or the coefficient, the beta coefficient, 1.2077. And make sure that t statistics is higher than 2. And also, you don't have to report, but you need to know how good that data is. It's 23%. Now, if that number is 50%, whoa, it's pretty good. And then in marketing, some regression give you like 90%. So 90% correct, 10% not. Well, in financial data, we have high frequency trading, so very noisy. So that number usually is not very high. So what's useful for that? Oh, that's pretty useful. Here, I added, how do you using this model in the industrial version of index model, and later in capital asset pricing model. Capital asset pricing model, also called CAPM model. In CAPM model, we require 3 inputs. You tell me that 3 inputs. Now let's look at here. Hold on, let me turn off my radio. Okay, now let's look at the, I just added them together for illustration purpose. On I, here there's inputs. So you are given 3 market inputs. First is risk-free rate, T-bill rate. Here, I'll give you example, 2%. And the market rate of return, 12%. Okay, 12%. And the beta, as we estimate here, is 1.21. I round it up. Usually people are using 2-digit after decimal point. So 1.21. So Apple's data 1.21. Now you need to find out CAPM model, what is the required rate of return for Apple? It's a market required rate of return for Apple equity. So I'm going to key in the equation. Now remember, when you do enter equations, right? Use cell reference instead of a number. Always put the model using cells reference, because you can change input and the model will automatically change. This is why the beauty of a spreadsheet. So here I enter formula. Now I hope you can see it. Let me enlarge this one a little bit larger. Oh no, sorry. Enlarge this one even larger. Here. I hope you can see it. Oh no, too big. Wow. Okay, I'm going to enter formula in cell J, what is this number? J25. Okay, first I key in equal sign. Put equal sign in. You can see this. You can see it's on the top of the line. Equal sign. Equal sign means, okay, it's a formula. It's an equation, okay? So risk-free rate, I click the reference number here. So J21, risk-free rate, plus beta here is J23 times parenthesis. You have to use in parenthesis. So now we are calculate the market risk premium. Market rate of return is J22 minus risk-free rate J21, close parenthesis. Now let's see again. J21 plus J23 times parenthesis J22 minus J21, close parenthesis. Check. So its value is equal to 0.141. Now, by the way, now you can use in percentage to do it. But for calculation, usually, I only at the very end, I round it up to a percentage. So this one, 0.11, I can say, okay, percentage is about 14%. About 14%. Okay, about 14%. This is how we calculate required rate of return for Apple. This is the cost of equity, as we learned in corporate finance, is a return on equity, RE. It's a market return, a required return is 14%, based on its 1.2 beta, slightly higher than beta. So market beta is 1. So anything higher than 1, then it's more risky than the market. That's the systematic risk, measure systematic risk. Now the sigma part, measure total risk, which is systematic plus unsystematic. Now in CAPM model, people only pay attention to systematic, not the unsystematic, because you can easily diversify all those unsystematic risks, so shareholder will not pay attention to it. Now let's look at the regression line. In this case, the dotted line, this is your projected values. So your values along that line. Okay. Now do not confuse this regression with CAPM model. This regression, we basically is so-called industrial version of regression. We get the beta. We want the beta. And the capital asset pricing model itself is another theoretical model. Okay. So here is my your equation on. Here is the equation in textbook. I can do this, okay? So it's an industrial version, but we treat as if it's a capital asset pricing model. So expected rate of return for for security I, here's Apple, is equal to risk-free rate, the T-bill rate, plus the beta. I'm going to show you how to do the beta calculation, times the market expected rate of return. We are using S&P 500 minus risk-free rate. Now remember, some of the book say that market risk premium is above the risk-free rate. And for our calculation, we just use this formula calculation. We don't do we call it excess return. No, for regression purposes, it's good enough. Here's another example in Apple. Given the early Apple data is 1.3, beta is 1.3, and risk-free is 2, market expected rate of return 15%. So how do you calculate? It's 2% plus 1.3 times the risk premium equal to 0.189. Now this is the base on my last year's data. It's 18.9%, 18.9%. Because I said that when you do calculation, please using percentage, not the please using decimal point, not the percentage. Otherwise, you might mess up with that. So this is your exercise to do a regression on Amazon.com. You need to report what the estimate is, and don't forget. You need to say, is that estimate beta statistically significant? Because you have to check the t-statistics, okay? Then you need to plot with a linear regression. You fit the line. You need to do some editing by right-click. You need to figure that out. And given the situation, you are given inputs here. Is 1.5% for risk-free, market rate 15. What is the required rate of return according to the Sindel index, according to a capital asset pricing model? And then turn in your work. In your midterm, you will do something. I forgot what is in it, but you have to do similar things. This is the one skill I think the MBA finance student should know, because this is real something you can do. Some of the fund manager are using this to detect any undervalued stock, because undervalued, then their required average rate of return is not on the line, it's below the line. So you buy those line, or you sell if the certain stock, its rate of return is above that line. Is it because undervalued? You purchase undervalued. The book discussed that, right? But for the time being, just working on the interpretation of your data. That is important. As for the data, I'm going to post my Apple thing here. Now, at the end, I also show you why I want to using the model look like this. So you have an input version. Input area, and also have a model. Model is the red one here. So for example, if I change the risk-free rate here from 0.02 to 0.01, so what is the expected rate of return for Apple? Click that. See, it's automatically changed to 14.31. Now, if market rate instead of 12%, it is, let's say, 15%. So the required rate of return is 0.1. Now let's check. If the beta equal to 1, put a 1 in it. 15%. See that when the beta equal to 1, your required rate of return is exactly like the market. So required rate of return 0.15, 15%. Now let's look at the beta is less than S&P 500 1. Let's say 0.5, only half of it. To see what the rate of return is. 8%. It's 8%, almost cutting in half. So the idea about beta is, if we say that the beta is equal to 2, okay? If the beta equal to 2. The beta equal to 2 means if the market jump 15%, you almost jump double it. You will jump 30%, for example. But it's the one side of the story. The other side of the coin, if market drop 10%, what will happen? You will drop close to like 20%. So the beta measure the systematic volatility. High beta, high risk. Low beta, low risk. All right, here concludes my tutorial on this. How do you find beta? Goodbye.